iCoreConnect, Incorporated, ticker symbol ICCT. Will this 10x or will this lead you down to the truck stop? Welcome back to Strongman Personal Finance. We got to talk about a new hot stock that's up 254% in a day. Oh my God. Why would you buy VT or VTI or VOO or SPY when you could just buy iCoreConnect and make more money in one day than you'll ever make in your entire life? Well, let's dig into this company. What is iCoreConnect all about? Well, it recently just merged in a SPAC merger. That's right. This company is now publicly traded, and it provides cloud-based software as a service to medical providers. If you need help with patient prescriptions and, looking up patient records and all that kind of stuff, if you are a medical services provider, you might consider this software to help you run your practice. So it's all cool and exciting because we all know healthcare is going to be it generates a lot of money. Trust me, I know that for a fact. Healthcare generates a lot of money, and it's got a bright future in the United States and around the world. But you can't just go off that when you're thinking about investing into a company, especially a company like iCoreConnect Incorporated. So let's dig into some of the numbers here. Market cap, $1.11 billion on revenue of $7.63 million. That's right. The price to sales of this company right now, if this stupid thing actually loads, is a astounding 145. Now you may be like, wow, Strongman, that's just because it's a high growth company. Well, let's look at some of the factors on the income statement. So first of all, I like to look at revenue growth. It's had pretty explosive revenue growth in the last couple of years. I suspect there's some acquisitions, but most recently we can see a decline in revenues. That's interesting. So this company has declining revenues, and it has a price to sales probably the highest in the freaking stock market. What gives? We go down and look at their margins. Very high gross margins, a software company. Look at their operating margins. Negative 113% operating margins in the last quarter. Negative 73% before. Negative 74, negative 65. Their operating margins are getting worse. Their profit margin, this is operating margin after interest and taxes, negative 154%. Free cash flow margin, negative 60%. Wow. What is going on? We'll skip the balance sheet for now. We're going to look at their financial report. Let's look at their cash flows in a little bit more detail. Negative operating cash flows for every single quarter except for one. Capital expenditures, more spending, they're increasing that. They are just burning cash hand over fist. A company that burns cash every single quarter can only survive off of two things. Debt, which this company is packing on a decent amount of debt, and stock issuance. And remember, we're in a high interest rate environment. And when I was looking through a lot of their notes are actually coming due in 2023 and 2024, a big portion of them. And guess what that means? If they can't pay off those notes with the cash from the recent SPAC merger, guess what? They're going to have to refinance that at probably much higher interest rates, which is going to hurt their profitability even more. Now, I went ahead and looked at their most recent quarterly report, and I saw a very concerning thing. We're going to look at the balance sheet in a second. Check out the pinned comment below and join our Discord community where you can ask me questions directly via text, and if you sign up for the highest tier, you can actually meet me in person every 2 weeks. So check out the pinned comment, join the Discord community, and let's make some money. Going concern and liquidity. In accounting speak, going concern means that you're assuming a business will continue into perpetuity. When you look at a company's financial statements, you're valuing the assets based on cost, net of depreciation, etc. But you're assuming the company's not about to go bankrupt to be imminently liquidated. Because if a company was about to be imminently liquidated, you'd probably look at those assets in a different light, because when you have to do a fire sale of assets, you're probably not going to get the price that you think you're going to get. Look at this statement right here. In light of these matters, which we'll look at in a second, there is substantial doubt that the company will be able to continue as a going concern for a period of 12 months from the issuance date of these financial statements. What does that mean? They're basically telling you that there is a likelihood that the company is about to go bankrupt within the next 12 months. Now, they just recently merged. They just did they're publicly traded now, so maybe they got an infusion of cash. But guess what? That's only going to delay the inevitable. Now, if we go look at their balance sheet, if we have it up here, let's go look down the balance sheet. First thing I noticed, from December 31st, 2022 to June 30th, 2023, their cash position has shrunk by, what, $130 million? Is this even in millions? I can't even tell. It doesn't say it anywhere. Their cash position has massively gone down. Accounts receivable is down. This is not a growing company. When your AR is going down, I mean, it could be a timing issue, but it could also be that you're not getting as much revenue, which I think is the case for this company. Prepaid expenses is up. That's some good cash management right there. Let's look at property, plant, and equipment. They've expanded property, plant, and equipment, so they're doing capital expenditures, even though they're burning cash and they're not getting as many sales. Leases, they've amortized some of those. They've spent roughly, I'm guessing if this isn't that, if this is just in dollars, wow. They spent 200, maybe 200,000. I don't see thousands anywhere. Maybe 200,000. They're spending like freaking crazy, okay? And a big chunk of their assets, about 20% or more, is in goodwill. The vast majority of this company's assets, as a matter of fact, are in intangible assets. Software development costs, that's just money that they've put on the balance sheet that they've already spent that's going to be expensed in the future over the life of that software. Acquired technology, customer relationships, and these are all intangible assets. Okay, this company's balance sheet is trash. Look at their accounts payable. Oh my god. Oh my god. Look at their current liabilities. They owe 9.8, I'm guessing this isn't millions, $9.8 million in the next 12 years. And they have $1 million to pay it. Now, with the SPAC merger, maybe that's changed the fundamentals a little bit. But this company is massively underwater, okay? It looks like they paid off all of their debts. I guess that's good. I thought I saw that they had notes. Maybe they paid it off. But their debts have gone down. That's a good thing. But if they've paid off all their debts, but they can't pay their short-term bills, I don't know what's going to happen to them. Now, this company, if they get a huge influx of cash, guess what? They can probably last a little while longer. But that doesn't delay, or that only delays the inevitable, okay? Let's look at the income statement. Revenue is down. Revenue is down. They have declining revenue. Selling general administrative expenses are up significantly, okay? Almost 50%. Depreciation is down a little bit. That's good. This is crazy, okay? Look at their interest. Look at their finance charges. They are losing so much money. Look at the shares. Let's go down to the statement of cash flows. Okay, so let's see some of the add backs. So they have a pretty significant amount of amortization. That makes sense because they have a lot of intangible assets. A finance fee, a non-cash finance fee, and I'm wondering what that is. Stock-based compensation, $1 million. Wow. Not good. Okay, they burned a total of $1.9 million in, what, 6 months. Guys, you know, if you want to trade this and be a little trader, okay, you go right a frickin' head. But guess what? You're going to lose your butt. This is not a good company. This is a very dangerous company. There's nothing about this company that's good. At least some companies that are unprofitable have revenue growth. This has nothing. This is a human disaster. But go ahead. It's a future, bro. It went up a lot. Go ahead and buy it. Be my freaking guest. Cheers!